Good morning.
Morning. Morning, and thank you for joining us, everyone. Today, our seminar is Navigating Mortgages in the COVID-19 Environment. Before I introduce our speaker, I'd like to cover a few groundkeeping rules first. Everyone should be muted, and we ask that you remain muted throughout the presentation. There'll be a time for questions and answers at the end of the presentation, and we ask that you submit your questions in the chat feature. Our speaker today is Kristin Jamieson of the Jamieson Mortgage Team, powered by Success Mortgage. Originally from Kansas, Kristin moved to Central Florida with the original goal of becoming a nurse. Although she ultimately moved away from a nursing career, her studies helped lay the foundation for her business ethic and taught her the priceless lessons in working long hours and prioritizing. The work ethic has made her and her business one of the most successful mortgage firms in all of Central Florida. Outside of her business, Kristin is a tireless champion in our community and often volunteers for various organizations, including Kiwanis. Ladies and gentlemen, Kristin Jamieson.
I should unmute myself. That would help. Hey everybody, Kristin Jamieson with Success Mortgage Partners. Super excited to be here today to kind of go through a few things that I think will help people prepare for their financing endeavors for now and in the future, and just kind of talk about some things that you may not know as not being an industry professional going through the mortgage world. So just like everybody else, our business has been impacted due to COVID-19. Definitely not as impacted as some, but we are definitely seeing some changes that I think will help as long as we're making everybody in the community aware of what's going on. So I always like to start any presentation with a quote, and I found this one yesterday: homeownership is the cornerstone of a strong community. I definitely believe that, and here in South Lake County that holds true, but in business and in life, you have an employee that has a mortgage on their home, they're more apt to stay longer, just build that strong community foundation, and feel like they have a piece of the pie or of where they're living, a little place to call home. So mortgages are officially the bright spot in the current economic environment. Although there have been guideline changes, we are still a bright shot, or we're a bright shining star. Rates are still at an all-time low, which is super cool. So it's helping create affordability in the market, helping people lower, maybe reduce their mortgage payments if a refinance is right. And equity is at an all-time high. We are now in our 9th straight year of appreciating property values, which is really good if you're a seller today, or you want to take advantage of a refinance market to potentially eliminate PMI or some other things that we see in benefits of refinances. And yes, real estate is considered an essential business. So I've been in the office every day since April 2nd. We got our stay-at-home orders, working by myself because I do have my team working from home, but we are working and fully functional as of today. So one of the first things I wanted to talk about, because I got a lot of phone calls and a lot of questions, is what's the difference between the Fed's funds rate and the mortgage interest rates? And at the end of March, when the Fed dropped the Fed's fund rate to 0, I can't tell you how many phone calls we got asking, people asking if they could take advantage of the 0% mortgage interest rate. They are not one and the same, but they do parallel each other. So if one's going up, the other's going up. If one's going down, the other's going down. So yes, we did, when the Fed reduced the rate to 0, we did see interest rates go down as well, but we're not near 0. The Fed's fund rate, if by definition, is the interest rate at which banks borrow and lend excess reserves to one another on an overnight basis. So it has more to do with short-term interest rates and not your long-term mortgage interest rates. So it's based on the economic conditions. If the economy is strong, you're going to watch the Fed funds rate going up. If the economy is not doing so good, you're going to watch it go down. Now, a lot of other countries right now, their target funds rate is actually in the negative number. And I know they've asked Jerome Powell and a bunch of other economists if they think that the US will go to a negative Fed funds rate. And it doesn't appear that that's going to be the case anytime soon. Fed Reserve sets their targets rates 8 times a year. Now they have emergency meetings, just like we saw at the end of March when they brought it down to 0. So it can go up or down more than 8 times a year on an emergency basis, but traditionally it's 8 times a year when they meet. It has a major influence on consumer loans, credit cards, and again, your short-term loans. And investors do pay attention to the Fed funds rate because if the rates fall, it can sway the stock market. Now, mortgage interest rates. A mortgage interest rate, when you're paying interest on a mortgage, it's the percentage of mortgage that must be paid in addition to the principal balance. So there's some factors that you as a consumer can control when it comes to interest rates. Obviously, your credit score, if you've got a great credit score making timely payments, your interest rate's going to be lower than somebody who maybe has a history of slow pays on their credit or missed mortgage payments. So credit score has a big factor with mortgage interest rates, as well as the loan to value. Somebody that's putting down more money on a home or has more equity in a refinance, there's less risk to the end investor. So it's going to come in a result with a lower interest rate. And then the loan type or the loan term. Traditionally, you've seen the shorter the term, the lower the interest rates, because again, it's less risky. Since the 2000 market crash, that's not necessarily been the case. It's 15-year rates are still traditionally lower, but when you get down to the 10-year rates or even in shorter terms, it's hard for any company to recoup the cost of an origination in a mortgage when rates are super duper low. So right now we're actually seeing 15-year rates a little bit higher than we're seeing 20 and 30-year rates. And that's just because the end investor doesn't think that they're going to recoup the cost of origination and servicing before the average American will sell or refinance or pay their mortgage off, which usually happens in the first 5 to 7 years of a mortgage. Mortgage rate factors that are beyond your control, and we have no control as consumers. I mean, the overall economy, if the economy is not doing great, we're going to watch interest rates go down, which is what we're seeing right now through the COVID-19 environment, trying to stimulate the economy and provide affordability to consumers that are still out in the market. Inflation is a huge factor in mortgage rates. Job growth or unemployment rates are other things that we are watching. If job rates are going up and unemployment rates going down, it's a sign of a stabilizing economy. We're going to watch interest rates go up. As we've watched over the last couple of weeks, the unemployment rate going from 3.2 to, I mean, last week I think I heard Fed Chair Yellen say it's approximately 12%. We're watching rates go down. Other economic indicators that we watch on a daily basis are the reports that are going to change interest rates or in our market, or it's going to be things like gross domestic profit, trade. There's quite a few other reports that we're watching on a monthly basis that really, I mean, construction starts, construction spending, consumer confidence. If the consumer or the American people, if we're confident in what's going on, we're out there, we're spending more, we're not holding on to as much as our assets. So those influence mortgage rates more than most people know. And then the Federal Reserve, again, it's that we parallel. If we're watching their rates go up, our rates are going up, and vice versa, down and up. So that's kind of the difference. Unfortunately, mortgage rates will never be 0. But we've seen some in the 2s and most in the low 3s right now. So it's definitely a great time to take advantage if we're in a position to. So I'm going to bring into the benefits of a refinance. With property values being at an all-time high and interest rates being at basically an all-time low, there are great benefits to a refinance. So right now we're seeing we're getting phone calls, people wanting to refinance, possibly to take cash out so they can recoup some of their investment losses. I'm not a financial advisor, so if we have financial advising questions, I am going to refer you to the other chamber members that may be able to better answer those. But I know that I've gotten several calls in the last couple of weeks when people got their quarterly first quarter 401k statements or IRA statements and saw the loss. I mean, I know between Joe and I's accounts, one account we lost 20% and one account we lost 30% in the first quarter of 2020. And that's a lot of money to lose. And I know a lot of people are starting to get worried. So if we're looking to recoup some of the losses in our investment, that would be a benefit of a refinance. Again, equity is at an all-time high, rates are at an all-time low. We don't know what the future is going to hold. One thing that I mean, everybody's saying, or the economists are saying, or rates are supposed to stay low through the end of the year. And I do firmly believe that to be true. I know with the presidential election coming up, and obviously coming out of this COVID-19 new normal that we're all living in, they're going to do anything that we can to stimulate the economy and make it look better going into the presidential election. So I do firmly believe that rates are going to stay low through the end of this year. But as soon as there's any insight on the market coming back, you know, not the real estate market, but the market in general coming back to normal and people feeling more confident, those rates are going to go up. Because again, these low rates aren't sustainable. Another thing we're seeing a lot of people do is they bought in the last few years with maybe a 3.5% to a 5% down payment, but we have watched those values have gone up. So in some cases, people are now able to refinance to remove PMI from their mortgage, which, just as a reminder, PMI, or private mortgage insurance, is an insurance policy that protects the bank should you or the borrower default. So that way the bank doesn't lose out on their money. And I, like most, I don't want to pay for an insurance policy that doesn't protect me and for any longer than I have to, but it is a necessary evil in the lending side of things if we have less than that 20% equity. Term reduction, we've seen people close in the last few years with, say, rates in the 4s and even sometimes into the mid 5s in 2018. We've been able to successfully take somebody from a 30-year mortgage down to a 20 or a 15-year mortgage. So in reducing their term and with the lower interest rates, their payments are staying pretty close to the same, which is super cool, because if we can get out of debt 15, even 10 years, even 5 years faster, that's just better for anybody. Cash out debt elimination is a big deal right now. A lot of the credit cards out there have really high interest rates on them. And if we can take a 16 to a 22% credit card interest rate and our 4.5% mortgage interest rate and combined it all into a low 3-ish, in the 3%, low 3s, it's saving people a lot of money on a monthly basis. And then also freeing up that money on that credit card for possible emergencies that may arise going forward. We're also seeing a lot of people requesting money to take cash out to make home modifications for their children's or older adults staying, you know, aging in place or living in their home. Like communal living, I guess, is kind of where I'm going with that. It's home prices are up, so it sometimes doesn't make sense for somebody to buy a bigger home, but if they can modify the current home and keep all their family under one roof, we're definitely seeing that benefit out there. So those are just a few of the benefits I was able to pull out, or why people are refinancing right now. But now is definitely a good time. One thing I don't have on here is the way that we always structure refinances is we always structure to try to close between the 6th and the 9th of the month. So we fund by the 15th of the month, which allows people to skip 2 mortgage payments throughout this process with no penalty to them. So it's really helping people get through this if their wages have been decreased, or maybe some income coming in from the household has been taken away during the COVID-19 era. We do have a question from Dwayne before I go to the next one. Do you think that the PPP and CARES Act in place and a lot of government money going out there now, do you think that will cause a serious devaluation of our currency, thus ushering inflation? Well, I think that that's been a big concern even before COVID-19, where we've done quite a bit of money printing and our dollar isn't maybe as strong as it used to be. But I'm not really trained or educated enough to fully answer that question. But Dwayne, I will definitely get with some people that are way smarter than I am and see if I can get a better answer to you. I would hate to say something that's incorrect in that facet. So now we're going to talk about mortgage deferment and mortgage forbearance, because those terms are used interchangeably and they're really two separate things. The biggest thing I want to get across is the reason why our market, or why we're seeing the changes that we're seeing in the loan process, which we'll get to, is heavily regarded or coming from the CARES Act. A couple weeks ago, when they passed the stimulus, which is definitely needed, and I'm not saying anything negative, one of the things, a part of it obviously, is the president coming out basically saying that everybody is eligible with no qualifications to defer their mortgage or forbear their mortgage for the next, anywhere from 3 months, I've heard, up to 12 months. And why that is definitely needed and very helpful for many people right now. There weren't any qualification standards that were required. If I called, I'm still working every day, and I said that I'm impacted by COVID-19, my servicer, if I fall in the bucket of loans that are covered, has to grant that to me. And we'll go through the differences, but from a lending standpoint, when you have a government-backed loan, so your FHA, your VA, or your USDA loans, whenever somebody's not making their mortgage payment to the servicer, that servicer is still required to make that monthly payment every month to Ginnie Mae, whether they're collecting payments or not, until they can sell, or until the borrower can catch up, or they can foreclose. But that stimulus that's helping so many people, they didn't include the loan servicers in that. And I mean, if you think of somebody that even just has, $11 million in their servicing portfolio, if all of those loans went in, they would still have about a $2 million payment every month to Ginnie Mae. And that's just not sustainable for most of the servicers. So that's why we're seeing the restrictions that we are. And it's mainly because that we don't want to write a loan for somebody that's not going to pay, and the servicer has to keep paying their mortgages in the meantime. But off on that tangent, we'll go back to forbearance and deferment. So a mortgage forbearance, and I'm sure lots of you on the call have actually seen us in Florida go through hurricanes, right? So we go through a hurricane, we're affected by a natural disaster, we have the ability to forbear our mortgage payments. Most servicers allow for a 90-day forbearance. Well, with that forbearance, it depends on the servicer what they're granting, and it's allowing you to pause or reduce your payments for a limited period of time. It does not erase what you owe, and you have to repay any missed or reduced payments. And most of the time with a forbearance, so if they gave you a 3-month forbearance, on that 4th month, all 4 mortgage payments are due, like on that 4th month. And unfortunately, if you didn't have money to make payment 1, payment 2, and payment 3, most people aren't going to have the money to make all 4 payments when they become due on that 4th month. So interest is still incurring during that time of forbearance, and forbearances are always usually granted before the borrower starts to fall behind. So if the servicer, if you're calling because you've been impacted and you're calling to inquire about it, it's really important to get the terms of their forbearance and know your current financial situation. Because for most people, I don't think skipping 3 mortgage payments and having all 4 payments due on the 4th month is doing them any good through this. If we truly have a reduction in income and we don't have income coming into the household, maybe instead of asking for that forbearance, we're trying now for a deferment or a loan modification. So the deferment allows the borrowers to skip mortgage payments for a set period of time, and those funds get added to the backside of the mortgage. It's more flexible than a forbearance, and it can be paired with a loan modification. So at the time of reduction in income, the lenders are going to look at what can the borrower pay and what can we do. Maybe we lower the interest rate for a set number of years and we defer 3 payments for them so the payment's lower when we restart. I mean, there can be a lot of different ways that loan modifications are done, but if we truly have a reduction in income right now and we're going to struggle to make our mortgage payments, we just need to make sure we're asking the correct questions to our current servicer, because you can call Wells Fargo, you can call Chase, you can call any loan servicer that you're making your mortgage payment out to. The government did not provide much guidelines or clarity. So it is going to be lender specific on what they're going to offer and what they're going to do. But I do just caution anything you do as a consumer, you get it in writing. Now, what problems can asking for a forbearance or a deferment cause you as a consumer going forward if you're wanting to finance again? So in the eyes of a lender, and don't shoot me because I don't necessarily agree with this, but in the eyes of a lender, if you called your mortgage servicer and asked for a forbearance or deferment or a loan modification, you are struggling, right? Times are tough. We're not able to make our mortgage payment. So Fannie Mae and Freddie Mac, which are the big mortgage-backed security entities, along with FHA and VA and USDA, they've put out guidance in the last week that they are not allowing any borrower that's currently in forbearance or deferment to close, and further stated that they are not eligible for a new mortgage until they've made 12 on-time payments. So once the disaster period is over and we resume payments, a person who has gone into forbearance or deferment from a mortgage standpoint is not eligible for a full 12 months until they've made 12 months of on-time payments. So I've heard a lot of people out there say things like, well, I'm just gonna put my mortgage in forbearance. In that third month, I'm going to call you. We're gonna just refinance the whole loan and then it'll be all good. Well, that doesn't work, unfortunately, because anybody that goes into forbearance or deferment and the lender side is not eligible for until 12 months has passed since we've regained on-time payments. And it's a really sad thing because, I mean, we have people, I've had somebody that I'm working on a refinance for right now. She's a nurse, so her hours are not cut. They're actually paying them a little bit more during the COVID-19 time period that we're in. But she called her servicer just to inquire about it, and they automatically enrolled her in it. And so when I pulled her credit, I saw that it was in forbearance, and that's how I knew she had even talked to her servicer. But she was like, Kristin, I didn't ask for it. I just called to get information. But the servicers are so inundated right now with requests. You just have to be really careful about what you as a consumer are doing, making sure you're getting anything in writing and you fully understand the ramifications of what's going on with how your servicer has set it up for you. Now, should I take advantage of it? I kind of started on that. If somebody has had no loss in job or no loss in household income, I have to be the bearer of bad news and say your agreement that you signed at closing on your mortgage was with the loan, was with the note holder, your lender, not the federal government. If you can continue to make your mortgage payments, I would hate for somebody to not be able to buy or sell or do something that they need to do because of a decision they made today. Now, if you've had a loss in job and and your household income, but you still have the reserves to make the mortgage payment you've saved for times like this, I suggest you still make your mortgage payment. Obviously, if you've had a loss of job and household income and you have no reserves, you have no choice. Don't just not make your mortgage payment. Make sure you reach out to the servicer, get in a plan that fits you and fits them. So that way, 12 months from now, something else you want to do, you can still do it. But just not doing anything is not going to make the situation any better. And just keep thinking, where do I want to be 12 months from now? And hopefully that will guide you in your decision making, because that's really what it boils down to, is the decisions we make today are going to affect what we're going to be doing 12, 15, 18 months from now. But they were put there as a resource and a tool, and if you need them, please use them. Now, the last 3 weeks have been kind of a roller coaster, and I know we have a lot of real estate agents and a lot of title companies on this call, and so I know they feel me. when it's coming through this, but I just want to kind of go through a few of the guideline changes. If you have more questions on what I'm saying, because I don't want anybody to focus on the negative, we still have a lot of positive things going on, but we've watched credit score increases on the government for government-backed loans. We've watched them go from 580 to 660 in a matter of 3 weeks. Lenders are decreasing the max debt to income ratio allowed on most of the government loan programs. Before, we were at 57% with nothing else needed, like we didn't have to show any extra money or savings or anything, and now we're at 48%, and with that debt to income ratio, a borrower is going to have to show at least 3 months mortgage payments in their bank account after closing for us to be able to go up that high. We at Success Mortgage Partners are no longer offering manufactured home loans. I honestly don't know of anybody locally besides maybe a local bank that are still doing them, but it's all risk versus reward for the end investor, and they are looking at manufactured homes as considered a layering of risk or a risk factor of something they're not wanting to take right now. Jumbo loans, which are your loan amounts of $510,000, $400 or more, are pretty much completely gone from the market right now. We do have ways of structuring to where we maybe do like a first and a second mortgage combo or something for somebody that's in that higher price point or in a refinance situation with a higher loan balance. So there are still some options, but I mean, until last week, we still had Chase and Wells Fargo that were doing them. They both have since pulled out of those markets as well. All non-qualified mortgage products are gone. So what a non-qualified mortgage product was is there were some of those 2008-ish loans coming back into the marketplace. So maybe a bank statement loan for a self-employed borrower showing that their income is derived, coming in from their bank statements, shorter waiting periods after foreclosures or bankruptcies. Those are gone. I don't know of any lender out there still doing them, but I mean, I could be wrong, but for the most part, all of our local lenders no longer have access to those programs. Rehab loans are harder to come by. So people, actually wanting to buy a house and finance in a rehabilitation with that, they're really hard if they're still out there. You're seeing lenders need more time from application to closing. You've got to, just like all of us, and I see many of you are at home, so is everybody within those lending institutions. I used to be able just to yell across the room if I needed something from somebody. Now it's, emails, phones, texts, trying to get through. So timelines are just a little bit longer for a lot of lenders, especially due to the refinance volume applications that were coming in prior to the economy starting to close down different states. We are re-verifying employment within 24 hours of closing, which before we only needed 10 days, but we have to do it within 24 hours of closing. So if there is a chance, I'm just going to use Disney for an example. We had lots of Disney borrowers at the time Disney announced their furlough. And unfortunately, we weren't able to honor some of those loans because they were going to be furloughed or laid off before their first payment date. So that's something to keep in mind. Should we enter a mortgage transaction if we know on April 18th, we're no longer going to have our full-time employment? And those are only questions that somebody applying for a mortgage can answer. I don't want to scare anybody or somebody think, everybody's at risk of losing their jobs, because we are, right, in the environment that we're in. It's just something to take into consideration. I hate to see somebody pay for appraisals, inspections, and things of that nature and then not be able to close because they knew that their job was in jeopardy before they entered into the application process. We are also requiring third-party verification of self-employed businesses prior to closing. Age of documentation requirements. We used to be able to, say, have a bank statement or a pay stub that was 120 days old. They've shortened those requirements, and some loan programs are requiring the most recent pay stub to prove that somebody's income has not changed from when we initially started the loan file. So I'm going to go back to my Disney example. We had a client who was an executive and his pay was there, but then they docked executive pay by 20%. Thankfully, in this case, we were still good. We were able to close because they qualified with the 20% reduction in pay. But we're having to verify and re-verify. So if something changes in somebody's financial situation from the time they start till the time they close, it's just making sure that you have your loan officer, whoever your trusted mortgage advisor on speed dial to go through the changes. Because again, it's once something happens, we can't go backwards. We can fix a lot of things up front usually. Appraisal requirements have gotten pretty cool. That's one thing that I've seen as a positive change during this in the environment that we're living in. So most loan programs now are allowing for either an appraisal waiver, meaning an appraisal is not required, and that's all going to be determined by the automated underwriting system we use. Ultimately, we pick a value, or if it's a purchase, whatever's on the purchase contract. But on a refinance, we would pick a value that we think works, and we run it through our system, and it'll tell us if the end investors or Fannie Mae and Freddie Mac agree with the value that we put in. They've been taking statistical data on appraisals forever. So they know, I don't want to say better than appraisers because that's not true because the appraisers are living in our marketplace. So they have a good idea of what the value range could be on that home. And if the value is accepted, no appraisal whatsoever could be required. On loans that we're not getting that appraisal waiver on, we are seeing that almost all loan programs, unless it's a cash out refinance, they're allowing what's called an exterior only appraisal with a value. So the appraiser has to go to the property, take pictures of the home, but they're going to rely a lot on the listing and the interested parties in the transaction for interior photos or information about the property to conclude value. So they're not putting themselves at risk going into somebody's house, and we're not putting our clients at risk by having an appraiser go in their house. So that's super cool that they've kind of relaxed those requirements. And then the title closing process. Any of our title companies that are on this call, thank you, thank you, thank you for what you're doing. I don't envy you. Through the loan process, there's very few times where I actually have to come in contact face-to-face with somebody unless they want to come into my office. Pretty much everything can be done remotely, but that's the one piece of, well, besides inspectors, and we can kind of get to that later, but that's the one piece where we can't, they still have to have some human-to-human interaction with other people that they're closing the transactions on. But we have seen our title companies get really creative with ways that they're closing loans. So we're seeing title companies send mobile closing notaries to people's homes so people aren't having to go into another business. We're seeing what's called drive-by closings, and title companies are setting up outside with tents, and basically you're driving up, you're getting your closing package, you're signing it in your car, handing it back to them, they're doing their notarizing thing. And then we've also seen where like teleconference type closings where the borrower has been given the closing package, they're signing it in front of the signing agent via a Zoom call, and then taking the package to the title company within a certain amount of time so they can notarize and fund it. So we're definitely getting creative. Loans can definitely still be closed. It's just maybe not as easy or what we'd like to see it as, but we're closing them every day, but a special thanks is definitely needed and deserved for all of our title companies out there. You guys are amazing for sure. So with some of the guideline changes, I get another question that I get a lot is what advice is it a good time to be a buyer right now? Or what advice would I give my friends that currently rent? So homeownership provides stability. There's no increase in the fixed principal and interest payments each month. Now, payments can change based on taxes and insurance, but rent, there's no cap on what somebody can raise somebody's rent to. So it doesn't provide as much stability. We had a client a few days ago come to us to get pre-approved because her landlord, she had been in her house month to month forever. She was paying $900 a month. But he got a little scared when all of this started happening because, again, as a landlord, if somebody stops paying their rent, that landlord, if they have a mortgage, still has to make their mortgage payment. So he got a little scared, and he actually had put all of his rental properties with a property management company. When the property management company evaluated what the rental rate for that area should be, they gave her 30 days notice and said, hey, your rent's now going to be $1,600. Because that's what market rent in the area supported. Unfortunately, her income doesn't support an increase from $900 to $1,600. And I think, I mean, again, homeownership provides stability. I don't want to try to forecast the future, but I do see rental rates continuing to rise. So that's something to take into consideration. Rates are still at an all-time low right now. There's less competition in the marketplace. So I want to say, I mean, we have a lot of buyers that are pre-approved and we're out looking before coronavirus hit, or we had our stay-at-home orders in place. And they're kind of holding off on looking right now, and rightfully so, I understand. But what it's doing is, last year around this time, we were seeing lots of multiple offer situations, or people having to go over asking price to win the bid. Well, when there's less buyers out there buying, the chance of that happening or a buyer getting a deal on a property is going to be greater. And with equity in a all-time high, if a seller has to sell, they may be more willing to negotiate a little bit or have the room to negotiate. So there's less competition out there right now. I mean, there just is. Loans are still available with little to no money down. One of my favorite loan programs is the USDA loan, which is for low to moderate income families. And when I say low to moderate income family, a family of 1 to 4 has to make less than $86,400 a year, and a family of 5 or more has to make less than $111,000-ish. So it's very moderate income. I wouldn't consider either of those two numbers low income. And most of our area is still eligible. So there are ways for people that don't have money right now to still get into homes. It's actually cheaper sometimes if we can get the sellers to pay our closing costs as part of the contract negotiation, to get into a home for less than what it would be to get into a new rental. Obviously, home ownership has the ability for you to build equity. It provides income tax deductions. I think mortgage interest paid and charitable contributions for anybody that's not self-employed are the only two deductions that we still have available to us. Me being one of those people. It helps to build a stronger credit history. It's really hard for somebody, everybody wants those really high credit scores, and people play and with the numbers and what can they do. It's really hard to get over that 800 mark without a mortgage. And you can make your house your home. Obviously, it's fun to decorate and do everything you can with your home. So that's the advice I'm giving people. If you are still qualified, if you are still in the same financial position and you're just really at home a little bit more and have time to actually search and do the virtual tours, it's a great time to be a buyer out there right now. And as it is a great time to still be a seller because equity is at an all-time high. So if you have to sell, I don't suggest waiting unless you have to put your house on the market, because there are virtual tours, there are protections in place. The appraisals, people not having to come in. It's not a standard real estate transaction right now, if we want to put it for lack of a better term. So the best news is for us, we're still closing all loan products and loan programs in our office in 30 days or less. Doesn't matter if it's a purchase, refinance, USDA loans that people think take a really long time. USDA is actually less than 24 hours on their review. We're here to help in any way. Is a loan modification more beneficial than is a refinance more beneficial than going into a forbearance or a deferment situation for you, since you still get to skip those 2 payments? There's lots of questions and just lots of things out there, resources disposable to you. And I want to be one of those resources. So if you have questions on if something makes more sense for you, or if you want to get pre-approved, or you have questions about a refinance, don't hesitate to reach out to myself or anyone on my team. We're definitely here. And at the end of the day, it's our goal to get you in the best financial position possible going into Q3 and Q4 of 2020 and beyond. That's really all I've got for you today. I've got my contact information on the slide, and a special thanks to the Chamber for putting this together. And I hope somebody got something out of today.
Great job. Thank you very much, Kristin. We really appreciate you being with us, and we will make this available for folks who weren't able to join us today.
Fantastic. Well, thanks, guys, and have a great day, and enjoy going.